Hello, hello, hello. Welcome now, Stock Trades. I hope you're having a wonderful start to your weekend here, or I guess mid part of your weekend. In this video, I would like to make a response to a couple of comments that I've looked at the Reddit page, and I do believe these are valid questions. And if one has them, many will. So we're going to go ahead and take a look at this here, and we're going to share with you the screen. And I've developed a presentation for you guys to essentially sort things out so we can move forward and understand this a little another chapter to add to your financial literacy. So these are the comments on the Reddit page that we had, and we're just going to go through them one by one. We're going to do a presentation, and then we're going to go ahead and do an intrinsic value calculation and then answer some questions straight off of the cuff here. Okay, so this person said, wow, you went from base case, bull case, bear case scenario to 83 cents as fast as the stock price dropped. Okay, so this individual doesn't understand the difference between intrinsic value calculation, which is part of the bull base and recession case scenario, to the book value. So we're going to go ahead and we are going to talk about the differences between book value and valuation models. Okay, these are two different things. We're going to talk about them. Okay, this individual said, hard to take advice, which you should never take advice. This is a financial educational platform. To someone who said it wouldn't fall past 230. Okay, so in this regards, what is your Mr. Complex AD 8216? What is your experience with the market? When you look at a price of a stock, is that your only due diligence, or do you go and scratch the surface to go a little deeper? See, most folks, in my experience, they tend to, unfortunately, analyze the stock by how many people are talking about it. And if there's a lot of folks talking about it, and if the volume is high enough and the stock price is going up, it is a great company, right? But unfortunately, and we keep repeating this, but we have to keep repeating it over and over again because there's just so many investors out there, and not a lot of them are plugged in. A great way when you talk to someone, and if you want to know how much experience they have in the market, is about their patience. An intelligent investor is patient and knows that the stock price does not equal the value of the company. That in order to find the value, one must go deeper within the financials and understand the tailwinds and headwinds of the business. Okay. This particular person says, feels like some mixed messaging. You think it's headed to 83 cents, but based on the University of Michigan Consumer Sentiment Index, we should be buying. Well, I don't understand why there's mixed communication here. I said red is good, green is bad. I mean, it depends. I mean, look at Clover. It's red, which is good. And if you look at the Michigan Consumer Sentiment, we're going to pull it up here from our website here. You can see that we are at levels. This is from what year is this? Let's see, 1952 to 2022. I mean, just look at these levels. When have you ever seen it this low? 80s, right? Obviously, this is a great time to buy, right? And I personally think it might even get worse, right? So I don't think there is mixed messages here. I'm not too sure by what you mean there in terms of the mixed messages. And if you think the stock is headed to 83 cents, and I think this confusion is in conjunction with the confusion from this comment here, which is why we're making this video. Okay. So in 3 years, there is a 100% likelihood the stock will be up 50%. No. So when I said the stock, if you remember my past video, I said SPX. That data came from SPX. Clover hasn't been around for 50 years, right? So if you look at SPX, what is SPX? I said the S&P 500, which is this one right here, right? Again, unfortunately, when I read through these comments, there's just a lot of misconceptions here. Okay. Then he says, cool, in 3 years, it'll be worth $1.68. Okay. Where's your calculation? Where is your proof on that matter? And, it's obviously it's clear that there isn't any. But again, we're sorting through this because there's a lot of investors out there that want to learn, right? And these are the type of people we want to connect to. Okay. All right. If you take any moment in time and look for 3 years, the market will be pretty much up. Exactly. So why not take advantage of that? Which is exactly the point of the video. Okay. So now that we went ahead and kind of brushed through these comments, many folks say, I don't go through these comments. No, I do, and if I find something valid, I'll definitely be able to make a video about it and help. So now the difference here, this particular question, let's remind ourselves, wow, you went from base to bull and then, a scenario of 83 cents. Okay. So what is that? Okay. What is that? So now let's go ahead and then talk to you guys about this presentation here really quickly. So if you haven't realized, and some people have not, a lot of healthcare plays by CVS, Walgreens, and Amazon will drive more partnerships through tech investments. Okay. A lot of, CVS, Walgreens, Amazon, they have been purchasing a lot of these healthcare companies that are in the same atmosphere as Clover Health is. And if you have not seen that, I recommend you do your due diligence. There's a lot of opportunity in this market, and there's a lot of tailwinds. Now, there's a lot of folks that watch this channel from other parts of the world, and I understand, as someone who's first generation, I understand. Headwinds are winds coming at you on your face. That's bad, right? It's going to slow you down. Tailwinds is wind coming behind you. It's going to push you, okay? All right. So again, I'm trying to kind of help here, trying to help you guys out here. Okay. All right. So if you go ahead and look at the differences here, okay, we have book value versus our, valuation model. So what is book value? That's the 83 cents that we were talking about. So book value is the net value of a firm's assets found on its balance sheet and is roughly equal to the total amount of all shareholders would get if they liquidate the company, AKA, if Clover became bankrupt today, how much will shareholders be liquidated? And the answer is 83 cents. Every shareholder would get 83 cents if Clover ceases to exist. Okay. Well, that's most of the time when you look at a company, it trades far above its book value because the market prices future free cash flow. Now, normally in a market that's semi-quasi, not like 1980s inflation rate, the market allows and gives leeway because of the interest rates being historically low over the past 10 to 15 years, allows companies to be unprofitable and gain profitable by just focusing on growth. Well, everything's changed and turned on its head. If you recall last year, Clover did a share offering, more specifically stating and citing the fact that we are most likely going to head into a recession. So this company's always been ahead of the mark, and they obviously have people to help them. So there is a company, a hedge fund called Resassmans or whatever. I always forget their name, but don't let me forgetting their name undershoot their importance. They're the biggest day trading quanta algorithmic platform in the world. They're shut down, private, and they have invested a lot in Clover. And this company makes money. Even Warren Buffett, who is not a day trader, gives them and say they're geniuses. We'll make a video about it, and I think you guys would enjoy it. Just to give you, again, more education. As for each video I want to put in, I want you to learn something new out of it, okay? So what's the difference between book value and valuation model? Valuation method is used to estimate the value of an investment based on its expected future cash flow. DCF analysis attempts to figure out the value of an investment today based on the projections of how much money it will generate in the future. Okay. One is looking at how much it's worth today if they were to go bust, and the other one is looking at the future. Now, when you invest, you want to, obviously you're investing in the future, but you can use the book value, especially when the market becomes haywire, which is what we've been experiencing now. And if you don't believe the market is haywire and you believe Clover is the only stock that's just been destroyed. Go ahead and look at this. When was the last time we've been this low? Not a lot, not a lot. We've always been high. Okay. All right. Now, another example is Tesla as a darling. Just look at it on the year. It's down what, 44%. Just look at PayPal. Okay, PayPal. And I keep repeating this over and over again, but sometimes people just need to hit 60%. Okay. Sometimes people just need to hear it. All right. So what is book value per share? It's the total assets subtracted from the intangible assets plus the liabilities. So the intangible assets plus the liabilities are grouped up together with a parenthesis and are subtracted from total assets divided by the number of outstanding shares. Again, we teach a course about this. I know it's a lot, but I'm just giving it to you. If you want to learn more about it, you can go ahead and Google online. This is book value. Okay. Now, when we do an intrinsic value calculation, we like to go ahead and go 10 years into the future and discount back at a 10 to 15% discount rate using a 2% to 3% perpetuity model divided by the number of outstanding shares. Now, for unprofitable companies that have pizzazz and that have the ability to generate future free cash flow, we could take 5% of the revenue and estimates its future free cash flow and discount upon that. And we're able to basically see how much a company is going to be worth. Now, if you look at Humana, and if you look at more specifically their book value, which is what we're talking about right now, book value, back in 2012, their book value was $55. And if you go ahead and go to their book value now, they're $128. So their book value over the years from 2012 to 2022 has has grown from $55 to $128. And again, this is in USD. Okay, now let's go to Humana stock price. So if you go ahead and type in Humana, oopsies, and I'm doing this live, okay, stock. And if you go ahead and go to the max, and we go from, no chart is available. Well, there it is. I'm like, excuse me. All right, so 2012, right here, the market came off of the great financial crisis. So in 2012, it was trading just almost above its book value. $74 was the stock price. And if you go back, the book value around this time was $55. Now the book value is $128. And now it's trading literally, let's do the math, 4 times its book value. Okay. All right. So let's now go forward and let's go to Clover Health. Clover Health right now is trading at it. Right now, it's 82 cents. It is still, the stock price is over its book value. Now, it sounds to me clear that after the great financial crisis, a lot of companies were trading just above their book value. Now, there is an example of a company that's trading below its book value, right? The book value for SoFi is $5.65. SoFi is currently trading at $4.34. Again, definitely a weird time to be in the market. But again, why is it doing that? Because the market is sending a clear message. Wall Street's sending a clear message. Make a profit or we won't support you, because the money in front of you now is worth more than the money ahead of you. Okay? So you can take this as an advantage, right? And essentially secure yourself and do investments within this bear/recessionary market. And then 3 to 5 years out, the people who are essentially done this are going to be rewarded. And that's the point of life. You put in hard work and you sacrifice. And then at the end, if you continue to do that, the harder you work, the luckier you will get. Okay. So this is what we have for this presentation here. And just very quickly, if you look at the gross margins for Humana, it's oscillating between 20 to 18%. Clover used to be at 14.9%, and then they went downhill here trying to expand. And now this new CFO is going to bring them back up to 10, 20%. Again, if you have a company that knows its insurance, it can compete and give out more perks than Humana. And with their Clover assistance, they might be able to take more market share. I mean, look at Humana. It's making $39 billion. So now let's go ahead and do a quick intrinsic value calculation in our intrinsic value calculation model here. And without further ado, we can go ahead and we can look at the shares float for Clove. And if we go ahead and open it up directly to the SEC, we can see that the number here, 383 plus 94, it's around 477 million shares. So if we put 477 here, all we have to do now, they made around 475, and was it, correct me if I'm wrong, 2021. In 2022, they're expected to make 3 billion, 3.4 billion. We're not going to do that. We're just going to jump this 2023, and we're going to make them 2.3 billion. We're going to take 5%, and we're going to go ahead and estimate future free cash flow, 73.75 and 115. In fact, we could just delete that and just put 115 because we're estimating a revenue below what they're making this year. We're going to go 10 years into the future, and we can oscillate between 25% to a 30% growth. In fact, let's just do this. Imagine if they grow 20%. If they grow 20%, we're going to have a recession. Oh, let's go ahead. Before we do that, let's put the stock price $1.13. Okay. Put $1.13. We we see a recession case of 177%. In fact, let's just put 83 cents. Okay. 83 cents. We see a recession case of 277, a bear case of 6x your money, a base case of 8x your money, and a bull case of 12x your money. Okay. That's 20% growth rate, not 25%. Okay. 4x for the recession, 8x to 9x for the bear, 12x for the base, and 18x for the bull. Okay, let's go ahead and do 30%. 5x the recession, 12x the bear, 17x the base, and 26x your money for the bull. Okay. So the stock price, it's going to continue growing, and these free cash flows are going to continue growing even more once they're evaluated as a SaaS, once their Clover Assistant rolls online. But overall, like I stated, book value is different than intrinsic value. Okay. And a lot of these folks that comment, unfortunately, don't understand. And I don't know if you can see when someone became a member and, but based off of these comments, maybe, just maybe, they might not understand what they're talking. I mean, it's clearly they don't understand what they're talking about, which is why we made this channel to help retail investors thrive. We're going to go through the comments, and we're going to conclude the video. Please, I don't think this has any value in it. Maybe in 10 years might be worth $1. Okay. Can you explain yourself and why you think that? I mean, I'm curious, right? Dr. Kitty, which stocks are you talking about? Ups and downs, that is how life goes on. Absolutely. Anyone that was buying all the high flying stocks in 2021 will be lucky to be back in the green in 10 years. Well, yeah, that's the thing. If you did this intrinsic value calculation and looked at the value of the company, you would have seen that it was a 2x. It was 30, 40 based off of the projections of especially how the market's been oscillating. And you have to ask yourself, do I want to make 2x my money buying Clover at $28 at a high risk, especially when it's literally gone up that fast? That's when you got to use technical analysis and use your brain. Many folks bought at those all-time highs because, again, it was a game stock. They're gambling. That's what it wasn't investing. Okay. Let's see here. Question. Okay. So, hey, Al, for you, if Clover will be down to $1 for 30 consecutive days, will it be delisted? So that's a good question. We're going to make a separate video about this. I have seen this question float around. So the NASDAQ has these things where after 30 consecutive business days, let me just break this down. Not 30 consecutive days, 30 consecutive business days. So Monday through Friday. After that, the NASDAQ will basically send a letter to Clover saying, hey, you have 180 days to be compliant. Okay. So you can look at the NASDAQ delisting rules. So they have 180 days. I don't know if there's something you can read here. There it is. That's what I'm saying, guys. You go to the listing center, you go to the NASDAQ because Clove is listed in the NASDAQ, which is here. Okay. And then you do what you've been taught. You read and you look at 180-day compliance. And then guess what? Then Clover can do a couple things. They can not do anything and be OTC. And then once they become compliant again, they can be back on the NASDAQ, which I don't think they will do. It'll hurt their brand. Two, they could go ahead and become compliant and just go ahead and do a stock reverse split, right? And then go ahead and just become compliant that way. And they meet the criteria for that. Three, they can either just basically do an extension and then obviously have an excuse that we're in a recessionary environment and the NASDAQ will be more than willing. So this is basically kind of the drill here. And again, not many people, they try to, look into this. It's fine. Again, we're here to help and we're here to basically, again here, such companies must meet a $1 million market cap. Of course, Clover right now with all of its glory and all how down it's $540 million market cap. It's 540x the price of the minimum market cap value that particular security can be traded on the NASDAQ capital market. Okay. So I hope that makes sense. I know there's a lot. We're going to make a separate video about this so people can just, when they Google it, they can have a good explanation. But I hope this was helpful. If you like this video and would like more of these types of analysis and breakdown and just to give you guys a little sliver of education, please consider subscribing. And if you like the video, it actually helps. And it honestly serves as a motivation factor for me, knowing that I'm actually doing something and helping. Because there's a lot of work that I got to do in the hospital and whatnot. So it's just nice to be able to help outside the hospital. But definitely, if you give me some feedback, that'll be very nice. Okay. So overall, this is all I have for you. And I hope that this was sufficient enough. We should make a shorter video. It's just, again, there's just so many complex things to be taught about this. And it's hard. I saw one comment that stated it is hard to get to the point in such a minute because retail investors are unfortunately, far down below the threshold of what is needed to be successful in the market. And, this requires a lot of talking points and a lot of education. So, my apologies for that. Hopefully over time, as you continue watching these videos, the videos will become shorter. I won't repeat things over and again. I'll just say, watch my videos, right? All right, guys. Love each and every one of you. And I will see you on the next one.